Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump in, check out the special 14-day trial link below in the description for StockOracle.
Right, and just as a quick reminder, StockOracle is an AI-aided stock research platform. It is not financial advice, and it's definitely not a trading signal service or real-time market data.
Exactly. Also, just a heads up, that link is an affiliate link, which means the channel may earn a commission at no extra cost to you. And please remember that StockOracle's AI insights and valuation estimates can be incomplete or wrong, so always verify important facts on your own.
Absolutely. So moving into today's analysis on Nebius, ticker NBIS. We tend to talk about the cloud like it's this invisible, ethereal thing.
Oh yeah, just data magically floating up in the sky somewhere.
Right, but the physical reality of the artificial intelligence boom is incredibly heavy.
It really is. We are talking about acres of poured concrete, miles of thick copper cabling.
And tens of thousands of servers running so hot that they actually require industrial-scale liquid cooling just to keep from melting down.
Yeah, that physical layer is where the real money is changing hands right now.
It's the bottleneck of the entire technological revolution. I mean, we spend endless hours analyzing the software side.
You know, the large language models, the generative AI apps, prompt engineering.
Exactly. But none of those algorithms can run, let alone be trained, without massive, hyper-dense physical data centers anchoring them to the ground.
So for anyone managing a portfolio right now, looking at a company like Nebius is critical.
It gives you a direct lens into what analysts are projecting to be a $750 billion AI infrastructure supercycle over the next decade.
Right. If you want to know where the sector is headed, you have to follow the concrete and the silicon.
For sure. So let's start with the raw fundamentals, because the numbers coming out of Nebius are jarring.
Yeah, let's unpack this. We're looking at a trailing 12-month year-over-year revenue growth of 527.97%.
Which is staggering. That kind of explosive top-line expansion usually happens in early-stage software.
Right, not in companies physically racking heavy servers.
You're seeing that hypergrowth because Nebius is operating purely as a neocloud provider.
And to understand why that matters, you have to look at the legacy cloud giants, your AWS, your Azure.
Right. Those platforms were built over the last 15 years for general-purpose computing. They host websites, manage enterprise databases, run standard apps.
Using traditional CPUs.
Exactly. But training an AI model requires massive parallel processing. It requires tens of thousands of GPUs clustered together, firing simultaneously.
And Nebius didn't have to retrofit an old, inefficient network.
Nope. They are building out massive environments from scratch, specifically tailored for these incredibly dense AI workloads.
Okay, so that structural advantage seems to be showing up in their profitability metrics, but I have a major issue with the math on these sheets.
Oh, the margins.
Yeah, we have a gross margin of 72.06%, which is already sky high for a hardware operator.
It is.
But then we have a trailing 12-month net margin of 93.09%. I mean, I stared at this for 20 minutes.
Right, looks like a typo.
Net margins are what is left over after all operating expenses, taxes, and interest are paid out. It's mathematically impossible for a company to have a higher net margin than a gross margin on purely operational business.
You are right to flag that. It's a massive anomaly.
What accounting trick is creating a 93% net margin?
Well, when net margin exceeds gross margin to that degree, you are almost always looking at a major non-operating income event.
Like what?
In the case of companies undergoing massive structural scaling, this typically comes from a one-time deferred tax asset realization.
Oh, okay. Or maybe the sale of a legacy subsidiary.
Exactly, where the capital influx just hits the bottom line.
Yeah.
It's an accounting reality on paper for this specific trailing 12-month period, but it's not the forward-looking operational margin.
So we shouldn't expect them to keep 93 cents of profit for every dollar they take in forever.
No, absolutely not. That would be absurd for physical infrastructure.
No.
But the fact that their gross margins are holding above 72% is the number you should actually be focused on.
That is immense pricing power for a hardware operator.
And it exists primarily because they have engineered a very specific supply-side moat. And that moat has a name.
Nvidia.
Nvidia. They currently hold a 9.3% equity stake in Nebius.
And they recently injected $775 million of debt into the company. So they're sitting on the cap table as an investor, and they hold the paper as a lender.
Which fundamentally changes the risk profile for Nebius. Think about it. If you are a neo-cloud provider, Your entire business model hinges on getting your hands on Nvidia's latest GPU architectures.
It's the ultimate bottleneck. There's a massive wait list globally for these chips.
Exactly. By having Nvidia as a major stakeholder and financier, Nebius essentially guarantees itself priority access to the supply chain.
They just get to skip the line.
They skip the line, and that restricts smaller neo-cloud competitors from scaling at the same pace.
Like CoreWeave, for instance.
Right. If your competitors can't get the hardware to build out competing data centers, your pricing power remains protected. You don't have to race to the bottom on leasing rates.
And that $775 million debt injection serves a dual purpose. We're looking at a company with a $47.25 billion market cap.
Yeah.
And building data centers is one of the most capital-intensive businesses on Earth. You need billions in upfront cash to secure the land, the power, the cooling, and the hardware before you ever see a dime of revenue.
And that is the historical trap for infrastructure plays. They usually have to constantly issue new stock to fund their build-outs.
Which severely dilutes existing shareholders.
Exactly. Having Nvidia step in as a lender provides Nebius with a massive liquidity runway. It de-risks their balance sheet so they can fund capital expenditures through debt rather than dilution.
But Nvidia isn't just handing out $750 million out of charity.
Definitely not.
This relationship is a direct pipeline to the largest AI deals in the pipeline, like that recent Wall Street Journal report.
Oh yeah, outlining a massive financing package, somewhere between $250 billion and $750 billion, linked to Nvidia for OpenAI's new AI campus out in Ohio.
And the scale of this project is just difficult to comprehend. The power requirement for this single campus is 10 gigawatts.
To put 10 gigawatts of power into physical context, a standard large-scale enterprise data center might pull 30 to 50 megawatts.
Wow.
10 gigawatts is the equivalent energy draw of New York City.
That is insane. You're talking about energy consumption that requires multiple dedicated electrical substations.
Potentially even its own localized power generation just to feed the servers.
Right.
This is an entirely different stratosphere of infrastructure design.
The market reacted immediately to this WSJ report, too. The stock popped 6% just on the news of the financing package existing.
Right.
But here's where it gets really interesting. How exactly does Nebius capture revenue from a campus built for OpenAI? If OpenAI is utilizing the servers and Nvidia is making the chips, where does Nebius extract its revenue?
You have to view it through the lens of core competencies. OpenAI is a software and research lab.
Right.
Their core competency is training neural networks. They have zero interest in managing physical server racks, optimizing industrial liquid cooling loops, or maintaining network switches at 3 in the morning.
They just want a turnkey compute environment.
Exactly. So Nvidia helps arrange the financing for the hardware, but they need an experienced infrastructure partner to actually deploy, secure, and manage that massive cluster.
Oh, I see. By being Nvidia's deeply integrated partner, Nebius positions itself as the landlord and the operator.
Bingo. As this Ohio facility comes online, Nebius secures a multi-year revenue floor simply by managing the environment.
They're essentially the designated property managers for the most expensive digital real estate in the world.
Which highlights a couple of major near-term catalysts for you to watch over the next 3 months. The first is Nebius's upcoming earnings report.
Right. Analysts are going to be heavily scrutinizing their forward guidance. They want to see the exact timeline for how they plan to deploy that $775 million in capital for these mega campuses.
The second catalyst is entirely macroeconomic. You need to watch the Federal Reserve and interest rate policy.
Because neoclouds are so heavily reliant on debt.
Exactly. Any stabilization or reduction in interest rates disproportionately benefits a company like Nebius. Cheaper debt lowers their cost of capital on these multi-billion-dollar build-outs.
Which drops directly to their bottom line over time.
Yep.
Now, with all of this structural tailwind, the revenue growth, the Nvidia priority access, the Ohio campus catalyst, you would assume the stock chart looks like a rocket ship.
You would think so, but the tape shows something far more volatile.
Yeah, Nebius is up 124% year to date. And if we stretch it back 52 weeks, the stock has returned 260%.
It's currently trading right around $187 a share.
But it's actually 37.3% off its 52-week high, which was nearly $300.
The technicals reflect a stock that experienced extreme momentum, followed by a harsh but necessary consolidation phase. I mean, a 260% run-up in a year is rarely a straight line.
But the underlying demand for the stock seems incredibly resilient. When the price pulled back to $164, it bounced aggressively.
Yeah, that 164 level served as a very firm technical support. It showed that institutional buyers felt that valuation was just too attractive to pass up.
And the trading volume throughout this entire consolidation period has remained robust. It's currently sitting at about 1.1 times its 3-month average.
Right. And do you know why that volume metric is so critical here?
Because if a stock drops 37% and the trading volume dries up, it implies that the institutional money has left the room.
Exactly. And retail investors are just holding the bag. Sustained above-average volume during a consolidation phase indicates that major funds are actively accumulating shares and establishing new cost bases.
They aren't abandoning the trade, they are resetting their positions.
Precise.
I understand the institutional accumulation argument, but there is a massive glaring issue on the tape when we look at insider activity.
Yeah, the insider says.
Over the last 90 days, insiders at Nebius, the executives and board members who know the internal mechanics better than anyone, sold 1.16 million MET shares.
It's a big number.
And the ratio is awful. We are looking at 40 individual sell transactions compared to only 3 buy transactions. If the Ohio campus is such a guaranteed multi-year revenue floor, why are 40 insiders unloading their equity? It looks terrible on paper.
I completely agree that optics matter. And 40 sells to 3 buys is a metric that demands scrutiny. But you have to contextualize insider selling against the sheer velocity of the stock's appreciation.
Because it went up so fast.
Right. When a company's equity value triples in a 52-week window, you're going to see executives execute standard profit-taking. Many of these sells are pre-scheduled plans triggered by options vesting at specific price targets.
So you're arguing it's just wealth management, not a lack of faith in the company.
Exactly. You have executives diversifying their personal portfolios after a life-changing run-up in their primary asset.
That makes sense.
If they were anticipating a structural collapse in the business, you would see this heavy insider selling accompanied by broader market mechanics breaking down.
Like a spike in short interest.
Yeah, or a collapse of technical support levels. But the macro trend remains intact.
I'm still keeping a close eye on those insider filings, though, because that selling does dovetail perfectly into the bear case. And we can't accurately assess a company without stress testing the valuation and looking at the downside risks.
The valuation for Nebius is undeniably steep. They are currently trading at a price-to-sales ratio of 53.82.
Which means the market is demanding investors pay nearly $54 today for every single dollar of gross sales the company generated over the last year.
Right.
And their PE ratio sits at 57.82. For a company operating physical data centers, not a pure margin software company, but a hardware operator, those are astronomical multiples.
They really are. In fact, one prominent analyst actually has a sell rating on NBIS, projecting a price target of $95.
That implies a brutal 49% downside from the current $187 price point.
The foundation of that bearish thesis is that Nebius is priced for absolute perfection. When you trade at 53 times sales, any operational stumble, a delay in the Ohio campus construction, a flight compression and leasing margins.
Or a disruption in Nvidia's supply chain.
Exactly. Any of that will cause that multiple to contract violently. There is zero margin for error baked into the current stock price.
And that vulnerability leads us directly into the most complex systemic risk hovering over Nebius and the entire sector right now. It's a speculative theory that critics are calling the AI circular financing bubble.
This is the critical debate defining the market right now. The bearish perspective questions the true origin of all this demand.
Are these $100 billion deals organic, or is it artificially propped up?
Right, propped up by Nvidia's own balance sheet.
Let's walk through the mechanics of how this circular economy actually functions, because it's fascinating.
It really is.
So Nvidia injects hundreds of millions in debt into a neocloud like Nebius.
Right.
Nebius then takes that debt and turns right around and uses it to buy massive clusters of Nvidia's own H100 GPUs.
Keeping the cash in the family.
Exactly. Nebius then leases that compute power out to an end user like OpenAI. And OpenAI is able to afford those massive lease payments because they are raising billions of dollars in funding rounds, heavily backed by Nvidia. It creates a closed-loop system where Nvidia is essentially financing its own customers to buy its own chips.
And the existential risk for a company like Nebius sits at the very end of that chain. Nebius is building 10-gigawatt campuses based on the assumption that OpenAI will lease that space for the next decade.
But if OpenAI or any major AI developer can't generate enough organic recurring revenue from everyday consumers to actually cover their massive compute costs, the entire cycle breaks.
The financing dries up, OpenAI defaults on their compute leases, Nebius is left holding billions in empty data centers, and Nvidia is left with bad debt. It's a house of cards.
That is a brutal sector-wide reset.
It is the ultimate systemic bear case. However, the counterargument is that this is simply the messy, capital-intensive reality of bootstrapping an entirely new technological paradigm.
How do you mean?
Well, think about the build-out of the early internet or the expansion of global telecom networks.
Oh, laying all that fiber optic cable.
Right. The infrastructure costs were far too massive for any single company to fund organically out of cash flow. It required massive localized financing loops to lay the cables before the consumer demand fully materialized.
So if you believe AI is a permanent shift, then this circular financing isn't a bubble, it's a necessary bridge loan to the future.
Exactly. And if it's just a bridge, it still guarantees a multi-year revenue floor for Nebius. They are securing contracts to build and manage the facilities today, regardless of whether OpenAI's specific software monetization strategy is profitable tomorrow.
They are locking in the contracts for the physical footprint, no matter who ultimately wins the software wars. So, synthesizing all this, we have the explosive 527% revenue growth, the structural moat of priority Nvidia supply, and the multi-billion-dollar catalysts in Ohio.
On the other side, we have executives taking profits, extreme valuation multiples demanding flawless execution, and the looming systemic risk of a circular financing loop.
Right. So where do analysts land on the final verdict?
When synthesizing all the analyst reports and sentiment data, the consensus lands on a bullish score of 8 out of 10.
Despite the very real 49% downside risk flagged by the bears.
Yeah, the broader market views Nebius as a necessary vehicle. For an investor operating with a 12 to 24-month horizon, analysts see the current $187 price point, which has already had a healthy 37% pullback, as an attractive entry point to consider.
It offers pure-play exposure to the $750 billion AI data center cycle.
And they are structurally insulated from smaller competitors simply because they have the capital and the VIP access to Nvidia's production line.
They are positioned to capture market share that legacy cloud providers simply aren't agile enough to take.
But as you evaluate Nebius, or any company in this AI infrastructure space, there is one final overriding constraint you need to consider.
What's that?
We have spent this entire show analyzing supply chains, GPU architectures, and multi-billion-dollar financing packages. But as we transition from 50-megawatt facilities to 10-gigawatt mega campuses, the ultimate bottleneck for this entire industry might not be silicon.
And it might not be capital.
Right. The true ceiling for the AI supercycle might simply be the physical limitations of the local power grids.
Wow. Yeah, what happens to valuations when you have the chips, the cash, and the land, but the local utilities simply cannot generate the electricity required to turn the servers on?
Exactly. You can engineer the most advanced digital brain in human history, but it's entirely useless if you can't plug it into the wall.
That is the ultimate reality check. Well, if you find our talks useful, please consider subscribe, like, and comment underneath.
And don't forget to check out that special 14-day trial link below in the description for StockOracle.
Yes, remember, it's an AI-aided research platform, so always verify those insights on your own. Keep scrutinizing the fundamentals, always look past the hype, and we'll catch you on the next one.